Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending January 22nd, 2021. And as usual, I'm joined with our chief economist, Clément Gignac. Good morning, Clément.
Good morning.
We've had, again, a very interesting week in the markets and in the economy. So I'll start with the typical overview of this week's markets. As you can see, a very positive week for equities. Nasdaq was very strong, helped by Netflix, which had very good results, but also the S&P 500 was strong. Emerging markets is the star of the show so far this year. Just to remind you, we are January 22nd, so there is only 3 weeks in the year, and we've already had 9.15% return on the emerging MSCI Emerging Country Index. And this is on top of Q4 of 2020, which was very strong for emerging countries. So a strong momentum there. Nasdaq pretty much regained the lead this week in North America, but EFI was good. TSX was strong. So year to date, you have good returns overall in equities. Bonds with rising rates, we still have some headwinds for all of the indices. The long index was down 68 basis points this week. We're down 3.2% so far year to date. Now there seems to be lots of risk appetite, let's say, or maybe we could say exuberance in the market. So we always repeat, no one ever got poor by taking some profits off of the table, and don't overstay your welcome in winning positions, and all of those cliche sayings that I can bring. But and we'll be showing some more indices later in this review. But a very strong start to the year, and we do encourage people to take profits where profits can be taken. Price of oil higher on the week. Canadian dollar followed suit. We're at 79 cents now. We think that there's upside all the way to at least 83 to 85 cents in 2021 for the looning. Euro was strong. Price of gold very volatile to start the year, but we still think there are some good returns there to be expected on the price of gold this year. COVID, so an update on the current situation. On the left, I always try to change up. So this is the 7-day rolling average of new deaths per 100,000 people. So in the States, it's zero point 0.9. It's less than it was a few weeks ago. European Union is going sideways at about zero point 0.8, and in Canada, we seem to be going sideways now. Good news at about zero point 0.4, which is also good news. We're a bit below those two other regions. But now one of the big risks to 2021 might be the new strains that we're seeing in the virus. And Mr. Fauci, Dr. Fauci in the U.S. Says that new data shows COVID vaccines could be less effective against some new strains. So one of the pillars that we had this year was that vaccination campaign will be going strong. If we have that, that could be a bit of a setback. So we'll see how it goes in 2021. In the US, retail sales were worse than expected, still above previous recessions. On the left, you see retail sales. They crashed last year, early in the year in March, rebounded after that, but now we're losing steam, and we had 3 consecutive months of negative growth on retail sales. So as you can see on the right, typical recession like the 2008 Great Recession, retail sales tend to fall and then after that climb back slowly. And here we had a sharp fall, then a strong rebound in the shape of a V, and all the way to being stronger than they were before the start of the recession. But now we're clearly losing steam. So the new stimulus packages that were announced in the last few weeks and that we've discussed extensively should be giving a hand here at least to stabilize the situation. This week in Washington, so starting afresh, Mr. Biden becomes the 46th president of the United States. So already some executive orders have been signed. I'll be discussing the one about Keystone, but kind of undoing what Mr. Trump did during his his presidency. So as you can see, Mr. Trump now at the end of his big of his long night, he's going back home. So stepping out of the White House and back into his company. So probably we won't be discussing Mr. Trump for a good while here in this review. So Canada Keystone Pipeline project cancellation should hurt exports, of course. So one of the first things that Mr. Biden did was to revoke the permit for Keystone XL pipeline expansion. So on the left, you see the map here. So the proposed pipeline going through Montana and Nebraska. This should not happen now. So of course, this will be hurting the prospects of exporting more oil to the U.S. The U.S. is our main client, our main partner for oil. So on the right, as a percentage of total, as you can see, for a while, 100% of our oil exports were going to the U.S. Now it's climbing down. We're at 96.8% now, and without the Keystone Pipeline, we should expect less and less going to the U.S. So Canada needs to build on its other partners for exports. Bank of Canada had an optimistic tone, giving wings to the loonies. On the left, this is the new forecast from the Bank of Canada published this week, January 20th. So I put a little red box there on in the table. The numbers in parentheses are the projection from the previous report, which was in October of last year. For 2021, expecting 4% now, compared to 4.2% prior. In 2022, now the bank is expecting 4.8 compared to 3.7, so that's a very strong upgrade to forecasts. And first forecast of 2023, 2.5%. So Bank of Canada is looking at some very good, strong years of growth for the Canadian economy all the way to 2023. And on the right, that supported the loonie, which was already on a strong uptrend, but now, as you can see, this is a 1-month chart. We started at 128.5. We're up to about 126. We were up at 126 this morning. We're to 1.27, but still a strong momentum here from the loonie. So that sums it up for the economic part. Now for the financial markets, I hand it over to you.
Thank you, Sebastian. So hello, everyone. So the first slide is, in fact, take the opportunity to maybe just a little post-mortem on the behavior of the market. So stock market, as ready earlier this week, this morning is into the red, but they have welcomed, I would say, the Biden presidency. So in fact, you can notice on the right side, the blue curve is the Russell, not the Russell, excuse me, the NASDAQ index, and the dark, the black one is the S&P 500, so the behavior. So in fact, this week it is a positive week with the close, but in fact, since the amount ago, I will say, is still very positive. So clearly, the stock market has ready to a record high. With that, keep in mind that, in fact, this bull market is fueled as well by the optimism on the vaccine and this kind of thing. So, but as you point out, Sebastien, could be a risk factor as well. Huh? You have to double check the efficiency of the vaccine. Dr. Fauci warned that maybe with the new variant, that maybe the efficiency is less. So this is some risk factor that we have. On the next slide, talking about politics. So this is the average performance. In fact, you can notice that very often, back to the Second War, when you have on political event, January usually very, very positive. But later on during the spring, very often you see some profit taken and the volatility start to show up. This year is a different year because with the pandemic, you have this vaccine aspect. So it could be a headwind, as mentioned earlier, if the efficiency is not as good. But we have tailwind as well with this $1.9 trillion package from Mr. Biden to stimulate the economy to be sure that we'll have not experiment a double dip. So it will be interesting to watch. So bottom line, as we have mentioned very often, we remain overweight equities because we have more 12 months or 2-3 years time horizon. But in short term, it could be some profit taking, but it would be a buying opportunity. On next slide, we present the ratio. Interesting ratio, the NASDAQ composite compared to the Russell 2000. you can notice that in fact that the technology stocks outperformed the small cap in US basically over the last decade. But now we can notice since last fall that something changing. So now people consider more the Russell 2000. Keep in mind that with the Democrats, they will have more infrastructure program coming. It would be Buy America, Made in America. So this kind of things could help more the Russell 2000 compared to the Nasdaq, which is more international companies, as you know, could be affected by the digital tax coming from Europe. So could be a headwind for the Nasdaq. So it's interesting. But notice what happened as well in 1999. Keep in mind at that time it was the bubble of .com. This time is a little bit different, but nonetheless, it's a reminder that in fact, NASDAQ are much more expensive, and Russell 2000, they have a great opportunity. They are very cheap stocks out there with some interesting rebound in the offing. Next slide. We talk about the risk appetite. They're running very high. So they have a survey done, in fact, and notice they have a question. What kind of level of risk do you think you're currently taking your investment? And this is a record high. And this is, you have here 2 decades history, and we have never seen such appetite, risk appetite. So usually it's a recipe for significant profit taking. And from time to time, last year, Sébastien showed this kind of weather, what is the expression, barometer, barometer. And you can notice that now we are closer to the red. And usually when you are there, it's because people are so bullish, and we have plenty of anecdotes with the high PO, the first day of trading up 50, 80%. So this is a recipe normally for significant profit taking or correction. So make no mistake, we are not the guru to know when that will happen. We think it will be a buying opportunity because we think the strategy to remain overweight stock, but it's probably time to scale down a little bit exposure equity or take profits if you are very aggressive in your strategy right now. So that's it for me. So what do we, oh, sorry, I want to forget. Sorry about that, Sebastian. So yes, it's an interesting one, that one as well. So the second chart at the bottom, the red curve, is a ratio, is a basket of the company with share buyback compared to the index. And notice since recently, it does underperform a little bit, but now they start to outperform again. So yes, share buyback is perceived as interesting. We have seen Netflix for the first time. We have a share buyback earlier this week, but notice, in fact, at the top is the insiders. Very often is in fact, is the top management of the company defined as insider. So in that case, they are selling, take profits. So probably they realize that their stocks are very expensive. Usually this is another signal that you can see some profit taking. So that's it for me this week. And now I start again and mention to what we have to watch next week, Sebastian. Back to you.
Sure, sure. So thank you. So in Canada, we'll have building permits and we'll have growth of GDP in November. And this morning we had retail sales in Canada for November. They were way stronger than expected. So we should have a bit of a better number than expected in November for GDP too. So October and November should be good. But the flash estimate from StatCan was also pointing towards a good contraction, a strong contraction of retail sales in December. So probably the next few months we'll start to see Canadian data deteriorating too. In the US Conference Board Consumer Confidence Index should be stable, but stable at a very low level compared to the peak prior to the recession. So we'll see if there's an impulse there. We'll have durable goods orders. We'll have the Fed rate decision. No change expected. And finally, Q4 GDP growth, the first time that they publish the figures, 4.3% is expected quarter over quarter, annualized in the US. So that's it for this week. If you want to reach us, ia.ca/economy. And as I mentioned last week, because of the new accessibility rules, we cannot put the PDF of this presentation on the web page along with the video, but you do get now subtitles for those that are impaired hearings or for on this video, we have it now. But if you need the PDF, you can always write at economics@ia.ca and we'll send you a copy of the PDF by email. So thank you very much, everyone, for your support. Thank you, Clement, for your insights.
Very welcome, and have a nice weekend.
Thank you, you too. And we'll be back with another edition of the Weekly Review next week. Bye, everyone.